Stock markets have an uncanny ability to surprise. Sharp up moves and down moves happen at unexpected times. The recent 6% up move in Nifty happened in the backdrop of sustained FII selling and the reciprocal tariff threat from President Trump. Where do we go from here? What are the likely trends going forward? Welcome to Geojit Spotlight. Nifty had corrected by 16% from the 2024 September record highs. This correction was caused mainly by four factors. One, India's GDP growth rate declined to 5.6% in the second quarter of FY25. The corporate earnings estimates, which were more than 10% at the beginning of the year, declined to around 7%. Two, FIIs continuously sold in the Indian market. Three, the Trump trade resulted in dollar appreciation and rupee depreciation, which further aggravated FII selling. Four, a lot of foreign money moved to Chinese stocks on expectations of Chinese growth revival. This scenario is now changing. FIIs have turned buyers in the market. Rupee has recently appreciated against the dollar. India's GDP growth has picked up to 6.2% in the third quarter of FY25. We are likely to end the FY25 with a GDP growth rate of 6.5%. CPI inflation has declined from a high of 6.2 in October last year to 3.6% in February. This will enable the Monetary Policy Committee to cut interest rates again in the coming monetary policy meet in April. This expected monetary stimulus, along with the fiscal stimulus provided in the budget through tax cuts, can facilitate a rebound in GDP growth in FY26. Corporate earnings growth of around 12% is achievable in FY26. This augurs well for the market. Also, the valuations have come down and most segments of the market are fairly valued now. The biggest challenge now is President Trump's reciprocal tariff threats, which are hanging like a Damocles sword over global economies and the markets. If the reciprocal tariffs are severe, that will have negative consequences for the market. On the other hand, if the tariffs are less severe than feared, it can facilitate a market rally. This remains to be seen. It is better to adopt a wait-and-watch attitude. Investors can remain invested in fairly valued, high-quality stocks like in financials, telecom, hotels, aviation, and the pockets of domestic automobiles, which are domestic consumption-driven segments which will not be impacted by Trump's tariffs. IT and pharma sectors, the export-oriented sectors, are now under pressure on fears of Trump tariffs. Investment in these segments can be considered after April 2nd, depending upon the outcome of the reciprocal tariffs.